Five, four, three, two, one. And we're back. This is This Week in Coverager for the week ending Friday, November 6th. I am Nick Lamparelli. As you can tell, I am in podcasting headquarters in Naples, Florida. And in Coverager headquarters is my co-host for this episode, Avi. Good afternoon.
Hello, everyone.
So Avi just dropped a bomb on me before we started recording. And let's see if I can do this right. Share the screen. Here it is. So Coverager is about to celebrate its 4th year as an entity. And man, that's unbelievable. And the first thing I noticed, Avi, when you sent me this email, you can see the date here, right? November 14th, 2016. The email has changed so much. I was actually commenting to Sheffy this week. I'm just like, wow, the email looks really good. And she had mentioned that there had been some changes. How do you feel about being 4 years old? What is it? Has time fly? Does it feel longer?
So, the Coverager goes a little further, but in 2016, November 2016, we rebranded and changed the name, built the website, the database. 4 years, time goes by fast, but then I feel like it's feels like a century. But what's interesting is if you scroll down and there's actually a tweet that was featured in the email by you, the lemonade story. And what is interesting to me is 4 years later, we're still talking about some of the same companies.
Yeah, I see Metro Mile there. It's amazing. It's like I've had several conversations this week about InsurTech and how it's not really InsurTech anymore. It's something, it's been co-opted and everything. And I can't believe that article is 4 years old.
Yeah, still relevant. That's
still relevant.
Still relevant. And 4 years. Looking forward to 4 more years, maybe. But
of course. What are you talking about?
Yeah, it's amazing how time goes by fast. And
So here's a little story.
Yeah.
Our journey began in May 2014 with a 4 a.m. alarm, coffee, and daily email with the unusual name of Insurance Entertainment. I remember that.
Yeah, that was a big day for Coverager. Yeah. Yeah. I still couldn't believe that we were able to secure the domain. It was available, coverager.com. Come on. That's a great name.
Yeah. So just scrolling up, this is like a who's who. Here we got Jay Farber, Michael Albert, Alan Egbert. So I remember this. This is where this event
in Boston.
When I first met Sheffy, because Sheffy presented here. I came to this event because I was living in Philadelphia. I came to this event because Sheffy was presenting.
I remember. Yeah, I remember she was in Boston. She was like, "Will the email go out? The email will go out." And the email went out. Yeah. So it was a long distance email. But time flies.
Yeah. And there's so much stuff. One of the things that I think is truly separated Coverager from a lot of other attempts at trying to do something like this is notice Filipino based, right? You guys were global right from the start. You weren't xenophobic and kind of stuck with, the US or the UK or the European markets. You kind of focused all over the place right away. And here's Metro Mile, listen, I'm a part of the Coverager family now, but it's one of the things that's like really separates Coverager is how in-depth you go through this, the type of insights you bring. You don't stick with the traditional US stuff. Hats off, really.
Thank you. It's, again, a lot more work to do, but celebrating for a moment, 4 years.
Okay, well, congratulations. So for those listening, this is This Week in Coverager. This is the podcast where we try to do it on a weekly basis, depends on the news cycle, but Avi and myself and sometimes a guest, sometimes Sheffy. We get on and we talk about different news items of the week, and there actually happen to be a couple of really interesting ones that kind of hit this week. So I'll kick it over to Avi. What was the first topic for the week ending Friday, November 6th?
So the first topic, and not surprising, Assurance IQ continues the losing streak ever since being acquired by Prudential last year. So this is the fourth straight quarter that the company is reporting a loss. This quarter was 30 million overall. If we look at all the quarters combined, we're looking at 78 million in losses for a company that was acquired for 2.3 billion. So, I mean, I'm sure Prudential is not happy. They're saying that they're happy. They're still saying that they're happy. I'm sure they're not.
They kind of
And
have to.
they have to, yeah. I mean, it's just an amazing story because if you look at the signs, and we've covered this story very closely, the company has a new CFO, new COO, new chief legal officer, new chief compliance officer. Now they have a new president. So most of the leadership, the original leadership of Assurance IQ, has either left or changed titles to make way for mostly folks from Prudential. But what is the biggest mystery to me, the biggest surprise is why Prudential has turned Assurance IQ into a Medicare business when originally when Assurance IQ was acquired, the biggest product, it was term life and final expense insurance. It wasn't about Medicare. All of a sudden they turned the company into a Medicare company. And now, you just so you understand how it feels like one company knows very well what they're doing, another company doesn't. And we have to bring up Willis Towers Watson. They've acquired Transact for under $1 billion, a company that is known for its Medicare practice, and they're competing in the space for a while. And it's worth going to just the recent earnings calls of the two companies of Willis Towers Watson and Prudential, just to give you a sense of how one has some clue of what they're doing and the other has no clue. So we'll start with Willis Towers Watson. So there's a question, and they're asking John Haley, can you give us an update from where you sit on how the business looks to grow in the fourth quarter this year? The fourth quarter, the open enrollment, which started in October. So this is the answer. Well, I mean, it's too early for us to say anything about what the fourth quarter is going to be like this year. I think that's really just the beginning. That's the answer for Transact by Willis Towers Watson. Now we move to Prudential. Robert Falzon is being kind of asked a similar question. And this is the answer. In preparation for the Medicare annual enrollment period in the fourth quarter, we accelerated our agent onboarding and training processes. While we are only 3 weeks into the annual enrollment period, we are pleased with the customer demand that we're seeing, which is driving considerable sales growth. So one company is telling you that it's too early to know, and this is a company that's been successful selling Medicare. On the other hand, you have a company that has no clue about Medicare, Assurance IQ, which, Prudential decided that there'll be a Medicare business, and they're very pleased with the demand. It's not easy to just go into Medicare all of a sudden. There are big competitors in the space. There's eHealth, there's SelectQuote, Transact, of course. Health IQ went into the space. So I wonder why. I wonder what is the reason behind this? Why is Prudential turning Assurance IQ into Medicare? Do they want to go away from the final expense? I don't know.
Yeah, I don't know either. And I'm with you in that the Medicare piece is a completely different piece, completely different expertise. I'm not sure if they thought that the business model, the lead generation element of Assurance IQ would translate well. I mean, that would be my guess, is that there would be some sort of synergy or overlap with the lead generation, but it's curious to say the least.
Yeah, and it's very expensive to onboard these agents. Now, keep in mind, this is a seasonal business, so You bring them for the open enrollment, and then really there's not much to do. And let's not forget Walmart that entered the space as well.
Yeah,
And
that's right.
Walmart is a big name. And uh, what I think, and this is my opinion, so I think ever since Prudential implemented all these new compliance procedures into Assurance IQ, they've been losing money, because a big part of Assurance IQ was running loose, doing whatever the hell they want, and moving forward. And you have a company like Prudential that cares about its reputation. They can't just do whatever, and I think that's really hurting the company. And I was actually speaking to a founder in the life insurance space, and they were very impressed with Assurance IQ, with their growth. They thought it was organic growth. They had great SEO or something like that. So whoever is new to the story, that's not the case. Assurance IQ has no SEO. They don't have any organic growth. It's all phone based. They generate leads from different sites, not great leads. But they really had that one product, mostly that final expense, some term life. And that's what gave them the success. But obviously, we're seeing this is a company that is losing money. And this is not what we envision, at least what I envision as InsurTech, someone that's appealing to the modern consumer, the digital consumer. So don't get too excited. They're losing money. Of course, they're not losing as much as Root. So we have to put it that, they're not losing as much as Root, but still, they're losing a lot of money.
It's you brought up something good, which is the cultural aspect. Prudential is a very conservative company, would be very concerned with, their brand reputation and all of that. This would be a big faux pas, right? If they did this transaction and no one thought through, like, okay, we made the numbers work, right? But no one thought through, but the culture doesn't fit. These guys are, more techish in what they're doing. And if they come in here, we're going to have to chain them up, and they're not actually going to be able to execute on what they're doing. I don't know if that's the case. That's sort of, if your description holds, I don't know, at 2.5 billion?
2.3, yeah, 2.3
Yeah,
billion.
that's like a fireable offense.
I think Prudential.
I've gotten fired for less.
Listen, it's really interesting, and again, I mean, I think they're too deep into it. But on the other hand, as you said, their reputation is worth more than that 2.3 billion. So
completely.
Yeah, they're actually investing more money into business, bringing all these compliance specialists, like things that Assurance IQ didn't really have in place to begin with. So they want to clean up the business, but this is the problem. Like you have to be real. A lot of the Medicare sales are not 100%, pure. We'll put it that way. and when you want to go with compliance and you want to go by the book, then your sales are hurting, and they're not fulfilling their potential, or the potential that maybe Assurance IQ presented originally to Prudential. I thought it was a bad deal. They're still happy because they say, well, it's not a business that's dependent on interest rates and life insurance, investment income, and all of that. Now the market is not doing really well in that case, but I think they could have used that 2.3 billion for something better.
As a shareholder of the company, they could have used that for a dividend. Just saying. Okay. Listen, I don't know enough about Assurance IQ to know what the culture is, and whether Prudential acquired them and then started to realize, holy crap, this is Zenefits all over again. We're going to have regulators breathing all over us. But like that, if that's the case, then listen, if this doesn't work out, there are two like potential big problems that are kind of hanging over a lot of other potential acquisitions. One is Assurance IQ was the Wild West. Prudential acquired them. They couldn't get the culture to work, right? That would be very bad for future InsurTech acquisition, simply because most of the legacy companies would be in the Prudential camp. Legacy, brand-oriented, reputation, risk tolerant. regarding that, and they don't want gunslingers coming in to doing that, or Prudential really screwed up,
Oh,
right? Like
yeah. I mean, it's
they misjudged the value of Assurance IQ, and they screwed it up, brought it in, and now we're just kind of like quickly, trying to clean it up. So either way, it's not good.
it all comes down to basics. And what we heard is that Prudential acquired Assurance IQ for the model, the Uber of insurance, they called it. And what is the Uber of insurance? It's mobilizing a workforce that is able to sell from anywhere. And, obviously life insurance companies, they struggle recruiting financial advisors, agent. No one wants to work on a commission these days. And Assurance IQ proved that they can do it, but they've done it with a very specific product that caters to a very specific audience. And we talked about this: people that buy final expense, or people that miss the boat to buy life insurance. They're older, lower income. They'll answer the phone. This is not a model where you could do it with millennials, or with car insurance, or home insurance, or renter's insurance. So I don't understand how do you not see the correlation between the business model and the product? It comes together. I mean, you really need to look at both of these things at the same time. And I think that's where they failed. They fell in love with, again, the flexible workforce, commission-based, 1099. But again, you can do it with
Yeah.
final expense. You can do it with very specific products. You cannot do it with car insurance, regular life insurance. So bad for them,
Yeah.
but I don't think, it's not gonna. I mean, what's 2.3 billion for Prudential, right? It's nothing.
Yeah. I would still prefer the dividend. Did you say it was 3 consecutive quarters or 2?
4.
4 consecutive quarters. Oh boy. So I was listening to a podcast with John Chambers, the former CEO of Cisco Systems, this morning, and that the conversation of acquisitions came up. And he talked about how how difficult acquisitions are, like just amazingly difficult, and how after a certain period of time, if they don't work, it's not going to work. Like after a certain period of time, like you're going to write it off. And so that's probably what we're going to have to look for on the Prudential balance sheet. Even if they don't announce it, we're probably going to have to look to see if they write off elements of this, and that would basically put the nail in the casket.
It really is alarming to see the leadership changes. Like, the president that is now only a co-founder. So you assume that he is not involved in the company anymore. And, that's not a good sign. It's one thing to replace the COO, CFO, we get it. But one of the co-founders as president kind of, so I think it's, it doesn't look good.
It's the broad-based change, right? It's you expect in an acquisition that different, some people will leave once the handcuffs are lifted, but it's more of the broad base. Like there've been a lot of changes. That's probably a bad sign.
And what we need to remind everyone is that Prudential is fixing the mistake. So last enrollment period, they acquired the company around October. That's when they've sealed the deal. They said that they had such great consumer demand on the platform, but they didn't have enough agents. So this year they're fixing it, and they're saying they've started onboarding. They've onboarded. They're doing well in that area. We read it. There's consumer demand. It's met. Next quarter is going to be the real test. Because if Assurance IQ doesn't make a profit, then we know they don't know what the hell they're doing.
It didn't work.
Yeah. So we're going to keep an eye out, and we're going to wait for Q4, and we'll see what happens.
Okay. We have our second and final topic. What is that?
Reef Technologies. So an interesting company. The history is a company that started out as an app software to help parking lots manage their spaces a little bit better. What happened later, they raised a big chunk of money, and they bought 2 of the largest parking lot operators in North America. And the vision was to reutilize or transform parking lots and incorporate businesses that will take advantage of the proximity to urban areas. And one of the good examples, and this is something we've talked about in our report about the topic, is ghost kitchens, delivery only restaurants. So basically, you look at the picture, it's kind of like a trailer. They prepare the food there, and they list the restaurant, the menu items on the most popular delivery apps: Uber Eats, Grubhub, Seamless, DoorDash. And delivery guys come in, pick up the food, and they deliver. And you're a risk professional, and you have to look at the implications when you compare to a traditional restaurant where you have diners and you have waiters and you have bus boys, and the accidents of slip and falls, and how it gets busy. And now you have this model where there are no diners. It's a very small space and it's delivery only. How do commercial insurers look at this model? Who do you think is in the right position to take out a master insurance policy and make sure everybody's insured? Is it Reef Technology, or is it going to be one-on-one? They're going to underwrite a specific business.
Oh, this looks like a very interesting model, honestly. Like there are economies of scale all over the place for a society and culture, especially after the pandemic, that's very, very much open to a delivery, much more open to a delivery system. I think the insurance related to this, if Reef can get insurance as well, like there's another revenue source for them. I see all sorts of economies of scale here, including insurance and finance, that they can really leverage. This looks very interesting.
Yeah, it really is, and it was picking up before the pandemic, of course, because restaurant owners were saying, wait a second, I mean, people are ordering delivery more anyway. And I think it was 2019 when off-premise dining surpassed on-premise. So the trend was happening already. Obviously, now with the pandemic, more people are going crazy and ordering in. And if this is the future, then you might look at fewer traditional restaurants that require a big space, and the fire department coming in to make sure that everything is working properly. And don't forget also the workers' comp element, the hospitality. In it, restaurants, they employ so many waiters, and that is going to go away, a big part of that. And it's going to be a big deal. It's going to be a big deal for commercial insurance companies, and because
Completely.
from the workers' comp, obviously they're going to have fewer claims, I assume, because of the nature of the business, but revenue is going to go down as well.
This is a very interesting model and really fits, where we might be in a post-pandemic world. There are all sorts of economies of scale here. There'll still be, I think there'll still be a desire, but this sort of thing really changes the dynamic of on-premise eating, right? Significantly. Like how do you make the numbers work? It's going to be a challenge, like for especially places, Avi, that you frequent, that might be like a small restaurant, just a few tables. I'm not sure how they make the numbers work and compete with something like this. I could see the more luxury restaurants where it's an event, it's it's an experience, and people want to get out. But as you said, like this is going to be this has already surpassed on premises, and I don't see that trend diminishing at all. And having empty space parking lots that may not be used significantly because people are going to be working from home. This is really interesting. I can't believe how much money they raised. That is an amazing amount.
Yeah, well, when you think about the operations that they offer, so what they do, one of the things that they do is they come to a restaurant owner and they say, well, let's do a revenue share model. We'll give you the space. We'll do even the food preparation. We'll take on the food preparation. You give us the concept. You give us the directions. We'll
and put
take
your
the
name on it or something.
Exactly.
Yeah.
Exactly. And this is we obviously we've been covering the gig economy and how that relates to insurance. I think obviously this enables more of the gig economy because it makes Uber Eats and DoorDash stronger, more demand. Maybe you'll have now a new category of gig, food people or chefs doing this type of food one day, that type of food another. So it really is going to be interesting, and really it comes to the point where who will take on the distribution of insurance, because there is no physical location for a place like that. Like if you go today on Uber Eats, you'll find ghost kitchens and you'll try to look them up. There's no address. You can't find it. So you talk about really identifying that these restaurants exist. I really think insurance companies will need to work together with Reef Technology to either offer policies. I mean, if someone is doing Thai food and there's a lot of frying, you'll have a higher premium. But if you're just doing sushi, cold stuff, the risk is not that great. So you'll pay less, but you'll need to work with these companies to make it work.
Yeah. The risk dynamic completely changes, because at a restaurant, there's a big there are a lot of insurance companies that sell property and casualty insurance to on-premise restaurants. And there's a lot that goes around with that, because you have, like you said, the workers' comp issue. I don't think the food liability issue generally will go away, just kind of changes. But the premise, the fire related stuff goes away. I mean, there's a lot of effort put on loss control, sending inspectors to a restaurant. Is your vent set up in a certain way? If Reef was bringing, again, economies of scale of loss control, like we're going to bring the safest equipment, and every one of those mobile homes, those campers that house a restaurant is going to be the best quality. Like they would be able to secure really top-notch insurance for that, because it's in a concrete bunker, right? Like it'd be really difficult for a chain of events to occur to wipe out one little thing after the other. You could control that. The insurance should be cheaper, and they would be able to pass that along. Like they could really deliver economies of scale. And I think for like a smaller restaurants, that better. Like they don't have to worry about the rent,
lease,
waiters, lease, workers' comp.
Yeah.
Like they would be responsible for it. This sounds like a potential game-changing type of thing.
Yeah, and there's other applications. Of course, it's not just restaurants. Whatever you can do mobile, and whether it's a delivery point of some sort. So you could think of other business applications and use that. I think it's really interesting. And I mean, I think insurance companies will need to look at this, because I don't know how many are opening traditional restaurants nowadays. Who will take on such a risk? You know how difficult the restaurant business is in general.
But this is a way for someone to do it.
Yeah, very little capital needed upfront. Of course, there's that whole revenue share, but there's other options out there, not just Reef. Everybody's doing it a little different. They're doing it utilizing parking lots. So very interesting.
Yeah, it's funny because the conversation I had with Travis Hedge of Vouch when we were talking about the pandemic, and he said one of the more interesting things that he saw was, with everyone leaving office space and other things, there's two problems. One is those companies need to remove all of that furniture and other items from the office, and they need a place to store it. So they're sometimes, when the lease is up, they're moving it out of one office and literally storing it in another. So there are these like Uber storage in it, like you could be in a skyscraper, 40th floor is completely open, and you just pack your boxes there in a walled space. Like a lot of like very quick and creative things are coming up because of this pandemic.
Oh yeah. I think it's there's a lot of trends happening now, and some people are very quick to adopt those, and it's really going to be. I mean, I think ghost kitchens is going to be a big deal in general, and really how agents. I don't know if I mean, how would an agent even get to such a location and know? But
it wouldn't. It changes the game for them too. Like this is Reef and companies like them are going to have so much leverage that they can just pick like 3 or 4 of the largest brokers, and the largest brokers are going to get access to them because they're going to need a lot of insurance.
Yeah.
Right. So the ability for an agent to sort of cold call or walk in or get, you know, I know the head chef of some local restaurant, like those will start to miss. They won't completely go away, but it's going to change dramatically even for a local agent.
Yeah. Yeah. Totally.
So ghost kitchens. I remember that. That's like we'll have to put that in the show notes. But awesome, Avi, congratulations! 4 years of the True Coverager. I'm very happy to be part of what it is you're doing because it makes such a big deal.
We're happy to have you, and we're ready to go.
Yeah, congratulations. So for everyone that's listening, this is This Week in Coverager. It's the week ending November 6th. So for our Avi, for Nick, have an awesome next week. So bye, everyone.
Bye.